If you're thinking about selling your house and you're wondering what kind of tax bill you're going to end up with at the end of the year, this video is for you. Today, we're going to talk about an often misunderstood tax benefit that could save you $500,000 when you sell your house. And this is legal, ethical, and believe it or not, actually required to be done in accordance with the IRS laws. Let's talk about how the IRS can actually work for you instead of against you when you sell your primary residence. Let's get started. Before we can get too far into this discussion, we need to talk about the two basic types of income that the IRS recognizes, and those are active income and passive income. For active income, this is also called ordinary income or earned income, and this is any money that you're making from your active business or a W-2, anything that you're trading your time for money in order to make a living. Now, the second type of income is passive income, and the IRS generally classifies this in a couple different ways, one of which is a capital gain. Capital gains are just the difference in what you pay for something when you buy it and what you make on the sale when you sell that item. So for example, if you were to buy a house for $400,000 and sell the house for $700,000, that difference of $300,000 is your capital gain. By the same token, if you earn $120,000 a year, then the IRS is going to take that $120,000 a year and they're going to call that earned income or ordinary income. Something helpful to know here is that earned or ordinary income gets taxed at a much higher level than capital gains. And in the case of this home sale, ordinarily the IRS would want a big chunk of that $300,000 that we're taking off the sale of this house. But there is a way for you to take all $300,000 or up to $500,000 tax-free on the sale of your house. So let's talk about exactly how you can do that. The IRS puts most of this information into Section 121 of the tax code. But most people just call this the capital gains exemption for primary residence homeowners. Here's how it works. If you live in a house for 2 of the last 5 years, you can take up to $250,000 of capital gains completely tax-free. And the best part is that once you get married, you can take up to $500,000 of capital gains tax-free. Let's use our example from earlier. If I sell a $700,000 house that I bought for $400,000 and I'm married, what that means is that I can take all $300,000 completely tax-free. Now, the IRS loves rules and regulations, so let's talk about the exact 4 rules and regulations that you need to meet in order to take full advantage of this tax-free gain. In order to qualify for this tax-free gain on the sale of your home, here are the 4 requirements. The first one is you must have lived in the house for 2 of the last 5 years, regardless of if those years are consecutive or not. The second rule is this house must have been a primary residence at some point during the last 5 years, meaning it can't be an investment property, it can't be a rental, it can't be a second home or vacation home, it has to be your primary place of residence. The third requirement, and this one may seem pretty obvious, but you have to actually own the home. So you can't sell someone else's house to take the gain that they are eligible for. The last rule, and this is something that people get tripped up on, is that you can't have taken this capital gain exclusion on a house in the last 2 years. So that's it. As long as you meet those 4 requirements, you can take a huge capital gain totally tax-free, which would usually be taxed at a 10, 15, or 20% rate. The cool thing about this exemption too is that those 2 of the last 5 years that I'm required to live in the house, those don't have to be right after each other. So they don't have to be consecutive years living in the house. So in the last 5 years, I could live in the house the first year and then move out, live someplace else for 3 years, move back into the first place for another year. That meets my 2 out of the past 5 year requirement. And then I could move out of the house and sell the house that I'm not even living in anymore for a $500,000 tax-free gain. That is so powerful. So at this point, you may be thinking, holy crap, this is awesome. I would love to take all that money tax-free, but Thomas, I haven't lived in my house for 2 of the past 5 years. Well, luckily for you, you may be eligible to take a partial exemption from these capital gains. And here's how you can do that. I work a lot with military home sellers and home buyers, so this rule works out perfectly for them if they have to move because of military orders, or maybe they're separating from the Navy or the military, something along those lines. So here's how that partial exclusion works. If you had to move because of an unforeseen circumstance, a health-related reason, or a job relocation, then you can take that $500,000 of total tax exclusion and prorate that day for day. Let's walk through an example really quickly so we know exactly how to apply this. If I'm a military service member and I'm married and I get PCS orders to move away from my primary residence, but I've only lived there for 1 year, the base rule for the IRS is that I can take $500,000 because I'm married over the course of 2 years of living in it as my primary residence. Under the partial exclusion, if I live in the house for only 1 year, I could take $250,000 of gain tax-free. Again, that $500,000 for 2 full years, I divide that exactly in half if I'm only living in the house for 1 year. Now again, the rules that apply to this is you still must actually own the home and you still must have lived there as your primary residence for some period of time in the last 5 years. As always, anytime you're going to apply some tax exclusions like this, you want to make sure that you're working with a qualified CPA and someone who can make sure that you're following all the IRS rules correctly. So we've talked about what the capital gains exclusion is on your primary residence. We've talked about all the requirements that you would need to take full advantage of that tax exclusion. We've talked about what you can do, or if you're eligible, if you've only lived in the house for 1 or really less than 2 years. But now let's talk about ways that some of my investor and flipper friends can take advantage of this primary residence tax exclusion to help save them even more money when they go to sell their nice new renovated house. In order to talk intelligently about this next part of the conversation, we need to define a couple more terms. The most important of which is what the cost basis is of an asset. In our previous example, we bought our house for $400,000 and then we ended up selling it for $700,000, which created a $300,000 capital gain. In that scenario, my tax basis or my cost basis for the house was just $400,000. But now let's say I'm a renovator or a house flipper, or I'm living in this house and I want to add a nice new kitchen. And let's say that new kitchen cost me $50,000. Well, because I'm adding value to the house, because I'm investing into the house, I can take that $50,000 and add it on top of the $400,000 purchase price. So now my basis, my tax basis is $450,000 instead of $400,000. So at the end of the day, what this means is that if I have a $400,000 house, I put a $50,000 kitchen in it, now my basis is $450,000. Well, if I go to sell that house for $700,000, like in my first example, now I'm only taking a $250,000 gain instead of a $300,000 gain, which means that if I were single and in this situation, I could take all $250,000 of the gain from the sale of that house totally tax-free. I mentioned this before, and I have to mention it again because somebody's going to get bitten because they didn't listen carefully enough. But if you're going to take advantage of this capital gains exclusion, it must be your primary residence for at least a portion of the last 5 years that you've owned the house. So you can't just purchase a house as a flip the house, go to sell it, and then try to take some of that gain tax-free, right? Because you didn't actually live in the house, then that doesn't qualify for this capital gains exclusion. The number of times that I've seen homeowners wait an additional 6 to 8 months to sell their house to try to meet this 2-year residency requirement is mind-boggling. And particularly if they're military service members who get short-term orders or have to leave on short notice, this can be a huge benefit to them because they don't have to sit there and pay their mortgage for those extra 6 months that they were trying to sell their house for. We're just about finished up for this week, but I wanted to recap and talk about the 3 super important points to take away from this video. The first point is that you can take up to $500,000 totally tax-free on the sale of your primary residence if you're married. The second thing is that $500,000, again, if you're married, is prorated day for day over the course of the 2 years that you need to have owned the home. And the third most important thing that I want you to take away from this video is that if you make improvements to your house, you are raising the basis, the cost basis of your house, so you may be able to take advantage of all of that $500,000 totally tax-free instead of just a portion of it. If you're interested in finding out more tax tips, more nerdy real estate topics, and more about how to make the most out of your home sale, give me a like and a follow, and check back next week for our next nerdy real estate topic designed to save you money and make the big bucks.